Hello and welcome to episode 417 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are we doing?
It's good to be back again, another week, and it's been a big week actually news-wise. I'll just throw this in at the beginning of the podcast before we move on with mortgages and savings rates. So mortgages, there's been a number, well, it's in the hundreds of mortgages being pulled by lenders, and their fixed rate deals have been going up again. We seem to be in another one of those periods, which is bad news for mortgage borrowers in terms of the deals available. So if you're due to fix in the next 6 months, the advice is still to go and get mortgage advice, because you may want to be looking at your options and locking into a deal if you can. Because don't forget, if you lock into a deal early and it changes, you have got options to look at other deals and actually go on to a better rate if they fall in the meantime. We've covered it on the podcast before, but I wanted to mention it now. We'll put a link in the notes of this video to an article that would explain how you can go about getting advice if you don't already have a mortgage advisor you can trust. But the good news for savers is you can now get 5% again on your savings rates. Now, there were ways you could do it using regular savings accounts. There are accounts like First Direct have one that gives you 7% if you save in regular monthly amounts, but there are caps on that. But there are now savings bonds, so fixed rate bonds that can offer interest rates of 5% or more if you're happy to lock your money away for at least 1 year. So we'll put a link in the notes of this show where you can find out more detail on that.
Yeah, and we'll be updating that regularly every week as those rates hopefully rise for the savers looking to grab a really good deal. So before we start the podcast, shall we look at some of the reviews we've been having recently?
Yeah, we've been promising that we were going to cover some of your reviews. Andy's going to read out a few of them that we've got.
Yeah, so the first one is from Richie Rich. He said, one of my favourite weekly shows. This is a must listen for top money related insights and opinion. The team really knows what they're talking about and could be trusted for updating the listener on a range of financial matters. The next one is from Daz60, who says he really enjoys the pod. Unfortunately, he retired through ill health in 2020 and he was embarrassingly financial naive. That's his words, not ours. He listens to the pod on his dog walks, and the breadth and depth of the content is spot on for novices. And the final one I'm going to read out this week is from Jeff, and he says, Damien and Andy bring the whole financial world to life in an amusing and interesting way during these tough times. My only podcast I listen to. So that's Jeff.
So that's great to get all of those reviews. Don't forget, it does really make a difference if you provide reviews. It's very motivating to the team, and of course it does help us in those charts on iTunes or whatever podcast app you use. If you're watching this on YouTube, because we are starting to film some of these podcasts and put them out on YouTube, please make sure you hit that like button and also leave comments and join the conversation. Each of those reviews, we will be sending out a Money to Masses mug if you send in your address. I think the last one, Jeff, is a particular friend of the show, and we've even met Jeff at a live event we did a couple of years ago. Got a feeling Jeff probably does have a Money to Masses mug, but Jeff, if you don't, then please do make sure you send in your address and we will send one out to you.
Good stuff. Okay, so let's get on with what we're doing in this week's show, episode 417. What have we got coming up?
So 3 pieces. One of these pieces is about the numbers you need to know. So your personal finance numbers that you should really know off the top of your head. It's inspired by my own finances. Again, these numbers I know and am very aware of and monitor at all times. The second piece on the podcast is relating to the payout rate on different types of insurance, how successful you are likely to be when making a claim, but also how you can increase your chances of your claim being successful. And the final piece of the podcast, Andy, is going to be you talking about...
I'm going to be talking about health conditions and which health conditions you actually need to advise the DVLA about, because if you don't, you could find yourself getting £1,000 fine. So it's an interesting, bit of a strange piece, but one that I think listeners will like.
Yeah, and particularly I think listeners will like, because it's not just 1 or 2, there's over 100 of these conditions. We're not going to list them all, but you'll find out more at the end of the podcast.
Okay, so let's start with the first piece then. Damien, you're going to be talking about key numbers and dates that listeners should be aware of or certainly be thinking about.
Yeah, so the personal finance numbers you should be aware of. These are numbers that relate to your own finances. And this, again, is inspired by the way I manage my own finances. And I'm aware that I do know these numbers off the top of my head. and it makes life a lot easier. Think of it like an emergency plan. So when you go to work somewhere, they always tell you about the emergency exits, or they tell you what you need to do in the event of a fire. It's that kind of principle. You know these facts because you just don't know what life can throw at you. So I'm going to run through some of these numbers. They cover all areas of your personal finances, and you will see that they are things that you're probably going to go and have to find out. If you know all of these numbers off the top of your head, you're already aware of them, then fair play, you're doing very well with your finances. Some of these are nice to have, some of them are things that I think you really should know. So I'm going to start at the top. Mortgages. Now, mortgages seem to be the big talking point at the moment. We mentioned that on last week's podcast. You should know what interest rate you are paying on your mortgage. You should better know that off the top of your head. You should also know what kind of deal you're on. You need to know when it ends. You also need to know whether if it's a fixed rate deal, when the end of that particular deal period. I'm not just talking about the whole mortgage term, when that ends, what age you will be, but also if you're on a fixed deal, when that ends. You know when you need to be looking to remortgage. You also should know what the SVR, the standard variable rate that you will default onto if you don't do anything about remortgaging. So that rate is normally very high. It will be a couple of percent above the average mortgage rate out there. So you should know all of those details. You should know your balance of your mortgage. It doesn't have to be today. It can be each year. You're normally sent a statement that gives you all of this information. And you should also know any early repayment charges on your mortgage if you've got a particular deal in place. Typically, if you've got a fixed rate deal, there will be an early repayment charge if you try to change that mortgage anyway. So, for example, you try to remortgage. Now, the reason you need to know all those pieces is they're very useful if, for example, there was a fundamental change in your life that required you to move, for example, or you might need to remortgage to release some money to be able to help you do something particular. And those details will already allow you to start thinking flexibly around your options. So find out those details if you don't know them. Another useful one, less important, is the overpayment percentage on your mortgage. So how much are you allowed to overpay before you incur or invoke any of those early repayment charges? So that is your mortgage. The next one I would think about is your net and gross pay. So you need to find out what your net and gross pay are if you don't know them. So most people know their gross pay, but do you know what your net pay is and what it should be? Because a lot of people just accept what comes into their bank account. And the reason that I say know your net pay, it helps to ensure you're on the right tax code and you're paying the right amount of tax, particularly if you're employed. So get your pay slip, work out what your net pay is each month, check it against one of the online calculators, the PAYE calculators that exist out there. If you search PAYE calculator on Google, you will find plenty of them and they can tell you what your net pay is, and it should match what's on your pay slip. The other number I think people should know is their hourly rate of pay. Now, you might not get paid hourly, but if you don't, then you can work out what your hourly rate of pay is if you divide your gross pay by 2,000. So if you're on 30,000, then that means that your hourly rate of pay, assuming you're working sort of 35 to 40 hours a week, is around £15 an hour. The reason I think it's useful is in determining value. So if you go and buy something, you go shopping, for example, then you can determine how many hours of work you will need to accomplish in order to have enough money to buy that item. And that enables you to control your spending somewhat. So that's a really easy number to work out, but incredibly useful. So keeping along the same theme of pay, you should know how many weeks sick pay you get. So check your contract if you're employed so you know what that is. Also find out what your statutory sick pay entitlement is. It will be £109.40. That is statutory sick pay if you're too ill to work up to 28 weeks. We'll put a link in the show notes that explains that in much more detail, but that's just to give you an idea. So the reason you need to know those numbers is because it helps in the event that you might become sick. So people don't think about this, but work out how you're going to survive, which leads nicely onto the next piece about survival funds or emergency funds. Work out what your total bills are. So look at your total bills and then think about the fixed expenditure, that's things like mortgages, or it could be rent, and you think about the income you've got coming in, and then you work out the minimum amount of money you have to earn. So if you had to survive because there was a shock, maybe you lost your job, it could be that you're on long-term sick, what's the minimum amount of money you need coming in to be able to survive? And to do this, you need to therefore work out your discretionary spending, So the things you can cut back on, you need to work out maybe the amount of money you might be putting away for savings and investments. So you could actually cut that back if you had to. You'll come down with this number. You need to know what that number is off the top of your head, and then you work out effectively the surplus you've got. So that's your buffer. Once you know that minimum amount, you can then work on building a cash buffer. So you also need to know how much money you've got in your cash buffer at any given time and how many months that could potentially last you for. I know there's different ways of thinking about cash buffers. Some people use 3 to 6 months gross salary, some people do net pay, some people do bills. But if you know that number, whichever way you do it, that's something you should know off the top of your head. Credit score. You should know your credit score. Now, I know there are 3 different agencies out there, that's credit rating agencies, and they all create credit scores in different ways. And I know there is no universal credit score as such, because every time you apply for credit, the lender you're trying to borrow money from will actually make an assessment about your credit worthiness. But if you check your ratings with the agencies, it gives you an idea of your credit worthiness. But more importantly, if you do check that, then you know you are staying on top of your credit report. So if you need to borrow more money for a reason, could be emergency, or you're trying to remortgage, or you're planning on moving, you now know already that you're not going to have a bump in the road or problem. You're already looking at it. So monitor your credit report. It also means that you will be aware if there is fraud occurring, or like identity fraud in particular. So somebody might have stolen your identity and taken out loans in your name. That will show up eventually on your credit report, and it will also impact your credit score. So make sure you know what your credit score is roughly. More importantly, whether it's excellent, good, etc., rather than the actual number. Make sure you know the credit balances on your credit cards. Now, going back to the previous point about budgeting, we'll put a link in the notes of this episode about how you budget, and it will give you links to articles on the website, but it will help you categorize different spending. You can also use budgeting apps. They're very good at helping you manage your money, but they are also useful, not just for the budgeting purposes on spending, but you can use the apps like Plum or Money Dashboard to help you monitor your balances if you've got multiple credit cards, for example. So you should know at any given moment how much money you've got on your credit cards. It will fluctuate as you spend and you pay it back, but also if you've got any loans, you should know what loan values they are, but you also should know the minimum repayments on all of those things, and you should also know the interest rate you're paying, because then you can start to manage them. And sometimes by having these numbers and knowing what they are, it can help galvanize you to make decisions, because you start to realize how much interest you're paying. Then you should also know your overdraft limits as well. If you've got any overdrafts, you should know what they are, because you might need to use them. Hopefully you don't, but you might need to use them. But equally, you should know your credit usage. Now that's the amount of credit you're using versus the amount you've got available. Now, the conventional wisdoms, if you aim between 15 and 25%, that is a good credit usage for your credit report. So that's going to be positive. If you use 100% of your credit limit, then that will be a negative on your credit report. So if someone was going to lend you money, then they're already seeing that you're maximizing your borrowing. So you need to know what your limits are, but it's also useful to know your liquidity. So by liquidity, I mean how much money could you access if you need to. Now, that could include things like savings that you've got in the bank. Think of it, I mean, we talked about in the office, and it's probably not the nicest way to describe it, but it helps visualize it. It's almost the fund that if you had, you're watching one of these Hollywood films and you've got a ransom demand, what sort of money could you get hold of quickly without penalty? And that includes savings, investments, that could include things like credit. And that number, that liquidity number, is quite useful to know, because if there is an emergency, something went wrong, do you have access to funds in the short term? So you don't really want to access them, but it's useful to know that if something went wrong, it's all about flexibility. So I know this number in my head. I know that if something went wrong and the car broke down, how much could I get hold of very quickly to fix a problem that I've got? And you want to keep that number at a decent level. So that's why you have cash buffers and savings. Moving on to pensions, you should know what your state pension age is. It was different for different people. For me, it's going to be age 68. You need to know what your state pension age is. I mean, most people will be 68, but if you want to check, because it does change, you can go on a calculator online and put in your date of birth, and it'll tell you what your state pension age is. We'll put that in the notes of this particular episode. You should know what your desired pension age is. So when do you want to retire? So when do you want to access your personal pensions? You need to know your employer and employee contribution rates if you're contributing to a pension at work, because it's useful to know your percentage contributions into your pensions. There's a rule of thumb that's out there. You shouldn't rely on it, but if you use your age and you haven't started a pension, then they use a rule of thumb that if you take your age and divide it by 2, that's roughly the percentage of your earnings you should be putting into pensions each month. So that means if you're aged 40 and you haven't started contributing, you need to be putting about 20% of your earnings into a pension each month. So that is a rule of thumb, but you can see if you know those numbers, you know how much you're contributing. The other thing you need to know is, when you want to retire, you need to know what your retirement income is likely to be. So we'll put a link in the notes to the calculators that can help you. If you know how much is in each of your pensions, you know what type of pensions they are, and you know the date you want to retire and the amount you're putting in each month, you can work out what your retirement income is likely to be. Now, there is always going to be variations in that. There's different factors you can change in terms of investment assumptions, but these calculators are quite useful. We'll put one in the notes of this video. You should know roughly what your retirement income is going to be and what your retirement might look like. It would also help you to know the percentage return that you're planning on achieving in order to get to where you want to be. And the reason I like to know that number is because in years when markets rally and you get them go up, say 20%, but you get years when they fall 20%, you'll stick to your plan. As long as your long-term annual rate of return is still above what you need to achieve your goal, whether it's retirement or whatever you're saving and investing for, then you know you're on track and it stops knee-jerk decisions being made. So make sure you know those details about your pensions. Interestingly, we've created an investment calculator at Money to Masses that can help you with working out your percentage you need to achieve your goals in the long run. So we'll put a link to that in the notes, because this is all about telling people what numbers they need to know and how they find them out as well. The investments, I think you should know how much you've got in investments. This counts for pensions as well. What are your charges per year? So taking into account all charges you pay, whether it's for financial advice, whether it's for platform fees, the underlying funds, you should know the percentage number that you're being charged each year. Most people find that hard to work out, but if you go on your platform of choice, you should be able to see what you're being charged on each part of your investments, whether that's the platform or the fund. Moving on to the savings rate. You don't need to know this, but I quite like this idea. It goes back to the pension contributions idea. What is your savings rate? So how much are you putting away for your future, whether it is just directly into savings, whether it's into pensions and investments? How much of that is being put into your investments, savings and pensions versus what you take home? So you basically work out how much you're putting away and you divide it by your monthly take-home pay, and that will give you your savings rate. You should roughly know what that is. And if it's above 10%, then that's good. If it's not, then you probably want to try and get it up as high as you can. Again, you can use that age idea I said on pensions. You can apply it across the board to pension, savings and investments. Of course, with savings, you need to know what your interest rate is that you're receiving, because you might be being underpaid. You might be better off shopping around. The last ones I'm going to focus on are related to your house. We've done mortgages, but you should know how much equity you've got in your house. You should know what your house is roughly worth. I mean, it doesn't matter if you're not moving, but at least you know what your options are when it comes to remortgaging, because you'll need to know what your loan to value is. And I think that ties in nicely. If you take everything I've talked about, you should know what your net wealth is.
Okay, so let's move on to the second piece of the podcast then. We're going to be talking about insurance, and specifically insurance claims, and how potentially you can improve your chances of making a successful claim.
Yeah, so in the past, we've done pieces on the show regarding when to claim on different types of insurance, and we've even talked about the risk versus reward. So when you need to take out insurance, or when it would be better to actually just put money aside. So there are 2 episodes that we've covered in the past. Episode 338 is the first one, and episode 324 is the second one. We'll put links in the notes of this episodes, you can find them easily. So the second part of this podcast, we're going to be talking about different types of insurances and their payout rate. So if you make a claim, the success rate of a claim being accepted and the money being paid out. We're going to look at general insurance policies, so travel, home, car insurance, pet insurance, but also personal protection policy, so income protection, critical illness and life insurance. We're also going to be talking about the reasons why claims are rejected. So if you listen to those reasons and you take them on board, then you're going to increase your chances that your claim will be successful, because you're not going to fall foul of the mistakes that some people make. So you're not doing anything wrong or dodgy to increase your chances. What you're doing is avoiding the common mistakes. So we're going to go from the worst payouts, the success rate. So the policy that's least likely based on the data that we found by looking around the internet and looking at industry numbers. You've got to take some of these numbers with a slight pinch of salt, because they are compiled from different types of data. But starting with the worst offender, then it's pet insurance. So the success rate is 63% of claims are paid out, which means that obviously 37% are rejected. Now, there are a host of reasons why they could be rejected, and it can be because they are making claims for things that aren't covered. It could be the pet's details are incorrect. It could be that the claim was made outside of the time period, that you may have a policy that has a time restriction on it, or there is a limit on the vet fee, so the actual claim is rejected because you've exceeded that limit. There could be a pre-existing condition that is not included on the policy, and also there can be things like you don't keep up your pet's vaccinations regularly, so they're not regularly vaccinated each year. That can actually invalidate your policy. So they are some of the reasons that Andy has come across why policies are rejected, because Andy, to give him his credit, compiled all of this research together. The next policy we are going to talk about is home insurance. 77% of claims are successful. And the thing to bear in mind, though, with that statistic is that it includes walkouts. So walkouts are people who may decide to start the claim or ring up and inquire about potentially making a claim, but don't follow through with it. So some of the numbers that we're reading out here aren't particularly comparable. This becomes very evident when we get onto personal protection. So what are some of the most common reasons why home insurance claims are rejected? Well, it could be because people are trying to claim for things that are just wear and tear. It could be there's incorrect information that's been given when they took out the policy. It could be lack of due care that actually caused the claim to take place, so they actually might reject it. It could be the non-disclosure of facts, or it could be potentially they're too late when they've actually made the claim, so there's a time restraint in there. So bear in mind that if you're making a claim on a policy, you need to ensure that you are covered under the terms and conditions. And the other thing to bear in mind, there are some ways you can invalidate your policy as well. If you have a burglar alarm and you don't put it on, then they may query a claim that you make. But also, if you are having work done on your house, so let's say you're having a loft conversion and they remove the roof and you've got scaffolding up outside your house, and you don't tell your insurer at the time about the work and how long it's been carried out for, and somebody breaks in because of that, that can also invalidate a claim as well. So bear those things in mind. Always check the T's and C's.
And let's look at the next one then. Travel insurance is a good one to look at. Now, around about 83% of travel insurance claims are accepted. And we'll go through some of the reasons why some of those policies are rejected. And so the main reason is a lack of the required documentation. So essentially that means that when you're submitting your claim, you haven't pulled all the facts together for them to make a payout on that claim. Withholding medical conditions is a big one on travel insurance. So when you take out the policy, you need to make sure that you're completely honest and you fill in all the details about your existing medical conditions, because there may well be exclusions. If you engage in any extreme sports and other risky activities, it may well reject your claim, because of course with travel insurance there are additional bolt-ons that you can do which will cover you for those things, but they're normally an additional premium. If your claim is as a result of any excessive alcohol or illegal drug taking, it will often be rejected. If you've left baggage or other personal items unattended, that won't be covered. And also, if you're traveling against FCO or WHO, the WHO advice, then that will likely result in a rejected claim.
And another thing to bear in mind, that most travel insurance policies will have a time period, the maximum your holiday can be, the period that it can last, normally about 30 days. So make sure you know what that is, because if you stay or go on holiday for a longer period in time than your policy allows, then you won't be covered. Moving on to car insurance, actually 97% of claims are successful when we're talking about car insurance. And that kind of makes sense, because most people will only be able to claim if they have an accident, so they probably are more likely to be accepted. And you always usually have to establish who's at fault. So I can kind of get why 97% is the success rate. Now, the reasons why people aren't successful with their claims is normally because of things like not disclosing any pre-existing medical conditions, maybe poor eyesight. It could be misstating what you're using the vehicle for. With this one, that means that you might state that you're not using it for commuting, but you actually are. You're saying you're using it just for social use, but you have an accident on the way to work. That could be a reason why your claim is rejected. Misstating where the vehicle is parked at night. So you may say that it's parked in a locked garage when in fact it isn't, and it's parked on a public road. It could be something called fronting. That's another reason why people have their claims rejected. And that's where the main driver of the car is not the same as the policyholder. So you're trying to use that as a way of getting a cheaper premium. But if you do that, then that is classed as fronting and you're likely to get your claim rejected. If you grossly underestimate your annual mileage, so you're trying to manipulate the premium by having a lower mileage, then the theory is you're less likely to have an accident, so premiums are lower. If you grossly underestimate that, then you're likely to have your claim rejected. Of course, there is a reasonable margin of error. They don't expect you to get it nailed right on how many miles you do in a given year. And the other one is failure to declare any modifications to your vehicle. So if you have modified your vehicle, then do make sure you tell your insurer.
And similar to your example with home insurance in terms of the burglar alarm, if you say that you've got a dash cam on your vehicle and it transpires that you haven't and you can't submit that footage, then your claim could get rejected as well. So that's an interesting one.
So that leads us nicely onto personal protection. And one of the key things I think about personal protection, a lot of people think they don't pay out or they're not likely. So you've got critical illness insurance or you've got income protection. They might not think they'll pay out if they need them. The reality is the payout rates on these types of policies are far higher than most people think. So I'm going to give you income protection. 81.6% of claims are paid out. So that's the policy where you may be too ill to work or unable to work, then it will start to replace some of your income. Now, we've talked a lot about income protection over the years on the podcast. Now, the reason it won't pay out, your claim is rejected, it could be that the deferred or waiting period isn't met yet. So you might have a policy that says you have to be off work or sick for a particular period of time, maybe it's 13 weeks or whatever it is, and you make a claim before that period's met. Or the most likely is there is an element of non-disclosure. So you applied for the policy, you didn't disclose something to do with your medical history or medical condition that you have, and it leads to a claim, then they might reject that claim. That's likely. With anything to do with personal protection, that is the most likely reason why a claim is rejected. Now, a big tip is if you are taking out personal protection, so for example, income protection, and you are worried that you can't remember the whole of your medical history, I mean, let's be honest with you, who can? Somebody like me with a pre-existing medical condition is a very convoluted and long history. You can just request they write to your GP. Now, normally what happens with an insurance product, if you hit certain limits, so you're taking out a particularly large policy, or you are considered a higher risk when they're processing your application, they're underwriting it, then they might write to your GP anyway. But you can ask that they write to your GP to ensure that all of the information that they require is provided by the GP, and that way you are covered. So that's what I've done in the past, particularly with my rather complicated medical history. So that is a good news story on that front with the income protection. Moving on to critical illness, that payout rate is 91.6%. Similarly, non-disclosure is the reason why most claims are rejected, or you're not meeting the required definition of a critical illness. And finally, life insurance, well, that's got a payout rate of 96.9%. And again, non-disclosure is the reason why claims are typically rejected. So the message is that personal protection policies have very high payout rates. So don't let that be a reason that you don't take these policies out or consider them. Now, one thing I'm going to have to just point out is that unlike, say, for example, home insurance, we talked about walkouts, people who thought about claiming but didn't in the end, those walkouts were included in these stats when it came to payout rates. With protection policies, they're not. So the people who are considered in these numbers are people who actually put a claim in, and then therefore the ones that are rejected are the people who tried to claim but didn't, not they just didn't decide to claim. So of course that does bump up the success rate slightly there, but don't let that detract from the fact that personal protection policies do have a higher than is often believed, so what people perceive, a higher payout rate than a lot of other types of policies out there. So Andy, that leads us on to the last piece of this week's podcast.
That's right. It's a very short piece, and we're going to be talking about the things that you need to let the licensing authority, or the DVLA to you and I, you need to let them know if you've had certain medical conditions. Now, there's a whole host of medical conditions. In fact, there's over 100. And the reason you need to let them know is you could be liable for £1,000 fine should you have been involved in an accident, and they can tie it back to that medical condition. So what I'll do is I'll read through some of the ones that you and I would probably expect to be on there. It kind of makes sense, just to give you an idea of some of these serious conditions that you need to let them know about. But then I'm going to list a few more, because these are ones that you wouldn't necessarily think would be on there.
Yeah, so we're not going to go through all 100 plus conditions, but as you say, there are some on there that I think there are people listening to this podcast wouldn't realise they probably should be telling the DVLA about the condition they're suffering from.
That's right. And the reason that the DVLA need you to let them know is because some of these conditions can be linked to potential problems if you're driving. And of course, they want to take a look at those conditions and work out if it's going to be an issue with you driving on UK's roads. Now, of course, they may decide, one, that they'll take your licence away. That's something they could do. And obviously, I know that's potentially quite daunting to do that, but it is a legality. They might decide to restrict the amount of years that you need to renew your licence. So in normal circumstances, you renew your licence every 10 years. They might say you need to do it every 5 years if you've got a certain condition, or every 2 years. So let's go through some of these conditions then. The most obvious ones, if you like, are the main conditions. Things like diabetes, heart conditions, and that includes atrial fibrillation if you've had pacemakers, if you suffer from sleep conditions such as sleep apnea, narcolepsy, for instance. It kind of makes sense. Obviously, you're in danger if you're falling asleep at the wheel. Things like epilepsy, strokes, and things that affect your eyesight, things like glaucoma.
So those are the conditions you first think of when you're talking about reporting conditions to the DVLA. Of course, there's some other conditions you might not necessarily realise that you might have to report to the DVLA. We have to put out there that it's all based on individual circumstances. So if any of the conditions that we mention, you actually have them, you need to go and check whether you need to report them to the DVLA, because obviously very personal to the individual. We'll put a link in the notes for where you can find out more information.
That's right. We'll put a link to the article that mentions all 118 conditions, but here are some of the ones that are slightly more unusual, slightly more left field. So there are things like bipolar disorders, manic depression. So, and actually going further into depression, there are a lot of mental health conditions that, even though not connected with anything to do with driving, could have implications with the DVLA wanting to know more about that condition. So just something to think about. Even something as fairly simple and mundane as blood pressure issues, and it's to do in that sense with the particular medication that you take, because it's the medication that might have some side effects that could impact your driving. There are other conditions such as broken limbs. Now, if you've taken more than 3 months off of work and taken 3 months off of driving, the DVLA need to know about that. Other things that you would need to consider that you wouldn't necessarily think of is drug use. So any history of illegal drug use or misused prescription drugs, you'd need to let them know. Obsessive compulsive disorders, so OCD, that's on there. Any sort of OCD, you'd need to let them know. And again, they'll make a judgment on that. And this last one, it encapsulates everything. It's just surgery. If you've had surgery of any kind, and again, it's major surgery that has required you to take a significant period of time off of work and therefore driving. So a good example of that is a cesarean section. So yeah. Interesting stuff.
So that is it for this week, isn't it, Andy, on the podcast? So as ever, if you've enjoyed the show, please make sure you go and review it. Give us 5 stars, of course, and you could get a Money to the Masses mug. As ever, go to the Facebook group, facebook.com/groups/Money to the Masses. Make sure you join the conversation there. And of course, go and find us on YouTube as well. We are doing more and more stuff on YouTube, particularly around savings rates if you're interested in that. And of course, don't forget to follow us on all of our social channels.
That's it. So that's it for us this week. We're done. Until next time.
Until next time.